Good morning. It's Monday, September 17th. This is George Kachuk with Know Your Options Inc. reporting to you from CME Group trading floor in Chicago. Typical Monday morning markets are flat to slightly down. However, the underlying trend in the equity markets is still up. In fact, over the last 4 weeks, all we've seen is 2 days of heavier selling, what we refer to as distribution days. The rest of the time, the market's been strongly accumulated by institutions and moving up. In fact, last Thursday, the market got another booster, or you want to call it shot in the arm, when the Federal Reserve came out and said they would continue to buy some more mortgage-backed securities to the tune of $40 billion per month, and they would also leave interest rates near zero till mid-2015. And they basically came out and said, hey, we're going to do whatever it takes, even if the economy improves, to get the market going. So the more underlying question right now is, will this new form of quantitative easing, which we're going to refer to now as QE3, will it start a new secular bull market? Well, it's a tough question to answer if this is the start of that. But what we can do is take a step back and take a look at where we are in a general market cycle. Right now, the NASDAQ at about 3180 is near all-time highs for the decade, basically going back to November of 2000. So it took out its resistance levels at 3134. It easily took out the highs of 2007, 2008. On the S&P 500, still a little bit of work to do. It's taken out the May 2008 highs, but still now it's approaching the October 2007 highs of 1576. So the NASDAQ at about 1460, the S&P 500 still has a little bit more work to do. So what's the significance of all this when I talk about a new secular bull market? Well, if you go back and look at the history of the United States equity markets going back to 1900, you tend to see that we get these runs of 20-year bull markets, 10 to 20 years sideways markets, then another 20 years of bull markets. So I take a step back. So right now, from year 2000, we've basically been in a sort of secular bear market, moving sideways since 2000, although we've had bull and bear markets in that. Prior to that, from 1980 to 2000, we had a 20-year bull cycle where the market just moved up about 1,300%. And prior to that, you had a 10-year sideways market from about 1970 to 1980. It was more like 11 years when the market just moved sideways, and there was your secular bear market. And again, prior to that, you had a 20-year upcycle. So is this the start of something new? Well, we won't know. However, what we do have is a market that's being heavily accumulated by funds. We have the Fed doing everything it possibly can to stimulate the market. So at this point, it's worth the risk of being long. Now, we are getting a little bit ahead of ourselves. The NASDAQ still has a lot of work to do to take out that 5,100 high that it made in 2000. The S&P is a little bit closer. It needs to take out 1576. Now, the Dow is very close. It just needs to maybe a few more points, a few hundred points higher. And if it can take out the 14,200 level, that'll be an all-time high for the Dow. So we're knocking on that door. So, of course, I wouldn't just throw caution to the wind and plow all your money in. You still have to watch the market. If the market starts selling off, be careful. But for right now, the trend is up. We still see strength in financial stocks, real estate, biotech, technology stocks. I've discussed some of these stocks in previous issues, or you can go to our website, Know Your Options Inc., where I have some chart analysis for you and some various stock recommendations. Until then, let price and volume be your guide. This is George Kachuk with Know Your Options Inc., reporting you from the CME Group trading floor. Good luck trading.